Hello, hello, hello. Hello, yeah, how's your mum? Good morning, everybody. Ready to trade some Forex? Do the euro pairs, dollar pairs, yen pairs, Swissy pairs. We can do gold, we can do oil, we can do natural gas, we can... Well, how about this? I'll even take your requests. So whatever you want, you're the boss. I'm just a humble currency trader. So without further ado, let's go. Boom! That just happened. Jigga Slim Shady. Hey, good morning, everybody. Let me remind you that trading's risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, and never risk money you cannot afford to lose. Ni hao ma. Hi, my name is Wayne McDonald. I am the Chief FX Market Strategist for TradersWay.com. Very nice to meet you. Hello. Hope you had wonderful holidays. Hope you survived and thrived, maybe. I don't know. But anyways, last week was, to me, one of the weeks that could have been a turning point. And cool, it wasn't, which is good. So I probably squeeze a couple more weeks out of this portfolio before stop and reverse. So that's cool. Anyways, thank you for being part of the community. Please tell YouTube that this is quality content that you want shared in your life. So you do that by clicking the like button and leaving comments. And I think leaving comments is probably the most important thing. So not in this live chat, but in the recordings. So if you're watching a recording of today's video, you should document what you learned, if anything. And if nothing, just say, hey man, hey, hi, but document, leave a comment. And that tells YouTube this is good stuff. Please do that. Also, Trader's Way brings these webinars into your life, so please pay it back. If you're finding that these webinars are educational, they are giving you sort of guidance, giving you the strength to get out of bed and do what needs to get done through education and confidence and consistency that you may need in your trading career to give yourself control. If this is all a blessing, then please show that by visiting tradersway.com and opening an account. I mean, they make it possible, so that's how you thank them, and please do, okay? So once again, ask questions, and I will do my best to answer them today, and also treat your other Forex trading brothers and sisters with the dignity and respect that they deserve. And if you're a troll, please disappear. So this is where we left off. You can see that over the Thanksgiving weekend, the trends have stayed in place. Everything seems to be okay. There wasn't a mass exodus out of positions, which was really good. I think during this critical week, I'm up 250 to 300 pips profit. So that's good. Because I was worried that this whole thing would come crashing down, and it didn't. So that's great. So now I'm focused on staying alive until the 12th of December. All right. So that's where we are. This is looks like I got Euro Lira here, and you can see that we had a little bounce last week, and now we're kind of caught in the middle. And you know, I'd like to kind of stay short in this area. If it starts going higher, I'm going to be worried about higher highs. I also know in here that there's a monthly pivot, right? Somewhere in here, let's say. I should be using a drawing tool. Hang on. So while I boot up the drawing tool, let's just switch this to monthly and I'll show you. Okay, so I know this 36 area is probably a good place for me to consider selling. If I'm going to give it one more hurrah, which I might do. I know it's pretty late in the cycle, and I'm really actually preparing to bail. You know what I mean? But do I not take the trade? I don't know. I don't know. So these are decisions I'm going to have to make in the coming, day. So we'll see if we get here to 36, 6.36 and change. Cool. So that's that. Everything else seems to be trending the same way. If it's been going up, it's going up. If it's been going sideways, it's going sideways. All that kind of stuff. And if it's been going down, it's still going down. So that's cool. So no new information is good information if you're in a carry trade. So when you're carry trading, you don't want to make too many pips, because if you make too many pips too fast, you start to freak out because it entices you to bail on your carry trade. And you're in the carry trade to catch the carry, but if you're making too many pips, you're just going to say, give me my pips. So that might be good in the sense that you're profitable, but it's bad as far as, moving you in and out of trades. So let's take a look at Euro-ZAR, and then we'll move on out of the exotics. Okay. Last week I locked in, several hundred pips anyways, 500 pips. So I locked in 500 pips profit, and I still have another 500 pips rolling. So it's bouncing on a monthly M2 and a weekly M2, and that does not make me comfortable at all. So since I'm thinking about bailing anyways, I'm going to lock in a couple hundred more pips profit and hope that this M3 still holds. So if I can get my drawing tool, there it is. So the hope here is, up and down. But we talked about this a lot last week, and you can see we have this mega highlighted. Okay. This is the end sort of thing. This is my Alamo. So if I didn't care about seasonality, every other month I would have had a plan like this. Okay. Well, this is not every other month, but let's just say it was. I would plan on something like that. So I think what I'm going to do is just see how this plays out. And if it goes above that, I'm done. Done for the year. Ciao. Goodbye. Okay. So my current position is up here. My current short position is right here, and I'm preparing to get out. Cool, right? Right? Danielle says, so there's a problem. Yeah, and you might think I'm being funny, but I'm actually not. I did put a chapter in my book about it. It becomes a problem, not when you're an amateur and you're surprised you make money, right? Right? Because then you're like, oh my God, I made so many pips. But later on, when you're doing your job, yeah, it's actually your prime stress. When do you take profit? You remember, like, a professional trader doesn't have like a 45 pip profit on one trade, right? They have 37 trades open, anywhere between 50 and 500 pips each. And they've already filtered out all the bad trades because you take small losses, and they're letting all their winners run. So when you're sitting on, let's say, 12,322 pips, yeah, it becomes a problem. When do you get out and throw away the income stream? Okay. Now you could do it from a financial perspective and do time value of money and all that kind of stuff, and just say, well, look, these pips are worth 2 years of interest rate payments. All right. Well, then fine, take it. 2 years of swap is a long time. Okay. So it will become a massive problem. Okay. If you do things right, your problem is you're making too many pips. But also, pips is not necessarily your prime concern, because you have trade plans. So it's not about how many pips you're setting on. If your goal, let me just throw something down here. So let's say I was a bull. Okay, let's say I was a bull here and I bought this as a double bottom. My target's going to be up here. It doesn't matter how many pips that is per se. I mean, it does, but it doesn't in the sense that, you know, if you're up 100 pips profit, do you bail out here because you made some magical triple digit number? Ooh, I made 100 pips. You're like, no, I took the risk. I set this trade up and there's a high probability it's going up here, 300 pips. So like, you should be embarrassed to freak out and take your 100 pips and run, right? That's not patience. That's not discipline. Okay? You see what I mean? So it's not the pips, it's the plan. And when I carry trade very often, seasonality is part of the plan. So the exit has to do with a calendar, not a price. Luis says, "G'day, Wayne. How are ya?" Oh, I'm doing great, Luis. How about you? Okay. All right. So that's it. That's exotics, whatever. Who cares? Move on.com. Boom, boom, boom. Okay. So have you guys caught all of the manufacturing data released recently? Right? Decent data out of China, decent data out of Japan, decent data out of Germany. So right now on the short run, that's good information. So here's our plan from September. And now look at, guys, this trade, this is what we talked about way back here a couple of weeks ago. The original trade is down here, up, 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 down, down, buy. And we talked about it here, 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 and here, and here, that this was the target. How many people can confirm that this specifically was the target? A cluster of weekly and monthly profit zone. No, not 20 minutes. It's in an hour. It's in like basically 2 hours, baby G. ISM comes out at 10, not at 8. How many people can confirm the weeks ago this was our target? So what do you do? This whole thing is now done. Okay? I just showed you day by day by day by day how to set up a trade that can last, let's say, what was this? Middle of September, all of October, and every single day in November. So November this year was 5 weeks. So let's say this was 10 week trade plan. And we've hit the target exactly, 10 weeks. How many people are willing to open their minds that they can have plans that last 10 weeks, not just 10 minutes or 10 hours? How many people are starting to open their mind to this possibility? And by the way, we created that trade plan in August. So let me give an extra click and put that in there. In August, our trade plan was in the 3rd week of August, buy it. We knew that there'd be a significant pullback in September, so that's not freak out time. And then this is like the 4th potential re-entry off the double bottom. Okay? Now, I guess you're thinking, well, what if it does this in December? That is plausible, and using technical analysis, this would probably tell you it's okay, that we'll do this and do this. Okay? That's what technical analysis says. And I'm going to override that with my fundamentals. And I say, that's what it looks like. Okay? But if you live in Florida, you know the day before a hurricane can be a lovely day. Or 1 minute you're sitting on the beach, you're like, oh, look how far the tide is going out. Isn't that interesting? Hey, man, things are going to change. Things are going to change fast. So I don't know. I don't know if it's going to do this or if it's going to do this. But I'm planning on one of these things. So what we've been doing the last, I don't know, is it fair to say 5 months? Everything I've planned and built over the last 5 months, I'm about to destroy. Okay? And there's nothing on that chart to tell you. There's nothing on the chart to suggest that. So, bear that in mind. You must say, well, that's Wayne's opinion. Wayne can certainly be wrong. But I'm going to pay attention and see what happens. There might be a great learning experience, right? And that's all I'm hoping for. Is a great learning experience. Okay, WTI. We had this great move back into the reversion, and now it's collapsed. Interesting. So, but at least look at the regression. Amazing though, right? So the regression has held. We're 2 standard deviations below the mean. What happens next could be important. Okay? If you're a bear, you got permission to fire. Okay? Now, if to set this up, if you are a bear, you could just take the shot and make it a swing trade. Or you will watch this, and this is for everybody here. If it breaks, it's going to drop, and then it's going to retrace back all the way back to the mean. Or, sorry, not to the mean, to the bottom of the channel. And then you'll get a second chance there. Okay? So, if I were to guess for this week, if I was a bear, this falls down to 53.63, rallies up to 56, and then next week you sell it around 56 and you're targeting 52. How does that make you feel inside? Okay. Sav says destroy, so something changes with fundamentals. Everything will change with fundamentals. TBM caught it at 58. Cool. Looks like you got a Friday front run, but you got a MR1, which is not a good entry, actually. So I don't know how the heck you did that trade. I guess you sold it here last week off of the weekly. That's a pretty aggressive trade. So anyways, congratulations. 58.60. Yeah, you must have been in it for a while then. Interesting. Yeah, it must have been in it. That's an aggressive entry because you're selling higher highs. So I don't know if I'd recommend that. But that's the price to do it, I suppose. 58, 50. Or you've been in there a long time. Well, TBM says sold at resistance, but that's not proper trading, right? Not necessarily. I mean, right? The first step is to confirm or deny that market conditions are favorable. Confirm or deny market conditions, okay? This is designed to save your butt over the course of the next couple of decades of you trading. When you go through a rough patch, it's because you're trading beautifully in the wrong direction, right? You're like, that was an excellent trade. You sold, right? At resistance. But it's an uptrend, dude. That's all I'm trying to say. So first, you should confirm or deny. And then second, set it up technically. And what I mean by that is sell at resistance or buy at support, right? So you sold it at exactly the right price. But I would never recommend something like that per se. Okay. So, now this kind of stuff is more tolerable. And then plus two, like, here's just another level of uncertainty here. You're at the mean. So you're selling in a neutral market that is trending up over the longer period. So in the short run, it's a neutral market. Long run, it's an up market, and you sold. I'm glad you're making money, but dude, be careful. That's all I'm just saying, right? Just be careful. Okay, be careful. Now, you might have had some bigger stuff on there that I'm not seeing. So maybe you go way out here. And yeah, so even then, the resistance is higher. Yeah, right, yeah, anyways. I'm glad you're making money. All right, All right, so yen pairs I need to go up, as you know, over this tricky week. And what happened? Well, we've been in a range since October. Okay, this is last week's M1. M1 is a bearish take profit. So bears look like they took profit. Nice. Now, we started the week way up here. Okay? We started Monday here at an R2. What happens if you hit early in the week an R2? Counter trend. And it counter trended all the way down to the bottom of the week. So we did an R1 or R2 M1 week. That's strange, right? It's only strange if you expect to be trending. You see what I mean? But it's not a trending market. It's sideways. So you're going to get weird gobbly-goo like that. Okay. But now we've gone to the bottom of the range to the top. So there's only two things that could likely happen. One, we head down. Okay. Or two, we break out. In which you would be trading way over here up. Now, can you see the bearish trade plan? M2 to three. MM3 to MM1. You see that? So if you are thinking about being a bear, that would be the trade. That would be the trade. Right? Kenya Forex, if you hit your target but you haven't been taken out, it's because you haven't covered your spread yet. Look at all this beautiful technical analysis I did for you guys. Look at that. Just gorgeous. Gorgeous. Oh, gorgeous. Look at that, huh? Cool. Sev says elections might move this. Yeah, well, I can't comment on that because that's not your normal scenario. So, yeah, you're going to have somewhat of geopolitical risk. So that's part of your analysis, right? TBM, I don't use Elliott Wave, so you can't throw impulsive legs at me. Okay? I'm making these decisions fundamentally TBM. So even if I was an Elliott Wave trader, I wouldn't give a damn about an impulsive leg because I'm not making those decisions that way. That's not what I'm saying. In fact, I'm saying nothing on the chart says this stuff. So if I'm right, you'll have to say, oh, that wasn't a 3 wave, that was a correction wave, and you'd have to do a recount and justify everything why I was right. But I'm telling you, I'm right here, there's nothing on your chart that will justify it. So don't throw down a dumb trade because Wayne told you to, right? So I'm just saying this is in my mind. And because it's in my mind, it's going to influence my analysis. So I'm trying to make clear to you why I'm interpreting what I see this way. Right? So that's that. So everything I could say right now could be totally gobbledygook garbage. Cool. It's still the truth in my mind. And it will still influence my decision-making process. But the fact that I'm making decisions will save me from horrific mistakes. I don't guess. I don't gamble. Right? I'm a machine. Okay? Cool. All right, so here's another thing saying, hey, right? Is this a bottom or are we going lower? Well, Luis, ISM manufacturing represents 7% of the U.S. economy. It's not that important. But you know what? Let's talk about this. What do you look at when it comes to manufacturing data? What do you look at when you go through a report? Type in a question mark to indicate that you don't read these reports at all. And by read, I don't mean like see the number pop up on the calendar. I mean download and read the report. How many people here are confident enough and have strong enough personalities to be willing and able to admit they don't even do it at all? Now, some of you might be shameful of this and like, oh man, I don't actually read the reports. And other people might say, look, all this is stupid anyways, so that's why I don't read the report. So I don't really know. But you're going to need to look somebody straight face in the eyes and say, I don't read economic reports. So I'd rather you be honest than fooling yourself and by therefore fooling me. I want to know if I'm going to invest in you, you need to tell me straight up. You're like, yeah, economic reports are stupid. They don't mean anything. Price determines everything. Dude, if that's how you trade, you better tell me. Mr. High Volt, I bet you can. Mr. High Volt, just read these reports for a year and you'll figure it out. Okay, but anyways. Yeah, right. Right, Mr. High Volt. You know what, just for fun, like let's open up the old one, I guess. So let's change the conversation because you may not understand the manufacturing data. But you guys understand the real estate market, the basics of it, right? How do you know the real estate market has collapsed? And meanwhile, I'll look up ISM report. How do you know the real estate market's collapsed as an investor? And it'll tie into this because it's all the same. No, don't go Fed and stuff. Just tell me, you're a real estate investor. Is now good? Not now, but like, how do you determine whether the market's crashing or not crashing? It's not a complicated question. Although I expect everyone to get it wrong. Now, Joe is a smarty pants. Joe's heard my speech before, which means he's got a Harvard education. Congratulations, Joe. Now, usually what people say is what Jean-Guy says, and that's actually what I expected was you'd say prices are falling. Okay? By the way, I'm looking at ISM, but I'm looking at you guys. Okay, but it's too late. By the time the prices are falling, it's already too late. So if you're sitting on $1 million home and then it dropped to 900,000, then it dropped to 800,000, what happens when you try to sell it? It just keeps falling, right? It's too late. You understand? By the time prices fall, it's too late. So Joe, with his Harvard education, says, no. You don't look at price. Price is lagging. And usually by a lot. 6 months at least, right? So you look at occupancy rate. And I'll give you an example of this. I guess I'll draw right over this ISM report. Here's the classic example of why this is true. Okay, you own a parking lot in a busy metropolitan area, and you have these parking spots. Now, let's redraw this slightly. Oop, come on. Let's draw this slightly better. Okay, parking spots. Okay, and it's $15 an hour to park here. Okay? And you own this parking lot. And you got a car here, and 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 here. So, what do? Your parking lot's full every day. What do you do? Once again, this is behavioral finance. And the answer to this will be amplified as Joe is saying that the real estate market is illiquid, which will also really impact all of this. No, they're already fully rented. Everybody every day shows up, they go to work. They have jobs. They go to work, boom, every spot in your parking lot is full every day. Yes, you could raise rates, right? And you keep doing that until you get nearly full. Okay? So every day now, you're at like 95% occupancy, but you're making an extra $5 on everything per hour. So 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, $55 more, but you lose $115, right? So you're making $40 an hour more at the higher price, but you have vacancy, right? Now here's the problem. There's something in humanity which makes prices sticky. Prices can go up really quickly. Okay? Prices can go up very quickly. And humans, for some reason, can do that. But for sort of greed and fear reasons, prices don't go down very quickly. And what happens is the economy changes and the price won't. They're still better off. Do you understand that? They're still better off. Now they're making $35 more per hour than they did when it was $15. Now they're only making $30 more per hour when it was $15. So they leave it, and they leave it, and they leave it, and they leave it. Now they're at break even, and now they're like, oh man, I should probably lower my price. And now we're here where they're actually forced to lower their price. But what's happened? Now they've gone from full occupancy at $15 an hour to less than half, and it's dead. This is why you don't use prices. Because by the time prices come down, you're already screwed. Okay? Now, another specifically to do with real estate. So imagine that, oh, that was real estate, right? Now, here's the other problem. How long does it take to build from scratch an apartment building complex with, let's say, 500 doors on it? How long does that take from the time you buy the land and hire the construction team and they start digging, they put power in the ground, they put pipes in the ground, and they start building the parking lots and start putting in foundation? How long does that process take? Four years? No, a year. It takes more than a year to build a house. So my neighbors, now granted my neighbors, so just on the other side of the lake, like the view that I have, 2 houses were built recently, but they're about, I think they're like 15,000 square feet. Like they have elevators in them and stuff. And it takes closer to 2 years, certainly a year and a half, just to build a house. One door. Okay? But I understand they're bigger than the typical person's house. Most people live in 3,000 square foot houses, not 15,000. But it's my neighborhood, and that's my example. My neighbors, both there's 2 houses. Okay. So, anyways, but an apartment building, I'd say closer to 4 years for that many doors and stuff. But anyways, my point is, real estate is even doubly risky because as you were losing parking spaces, what you forget is when you were booming and it was $20 an hour and you were always full, you can't make more spaces. So then you decide, you know what, I will make more space. So you buy the spot next to you and you start building a new parking lot. And it's until after the market has crashed. And now inventory tends to go up as vacancy tends to go down. And meanwhile, the value of the property is dropping because of the lack of income stream. And that's how finance works, right? The value of the property is the future value of all the cash flows that it generates, right? And plus the asset appreciation, depreciation. So real estate is really nutso. But the point I wanted to make here, because I didn't mean to do some real estate conversation today. Sorry. But what I wanted to talk about was the important part wasn't prices dropping from $20 an hour to $15, right? Because by the time that happened, it was too late. So when we're looking at global macroeconomics, we can look at things like manufacturing data. Manufacturing data, okay? And I asked you, what do you look at when you read these reports? And so we got a new report coming out, so I know you're going to read the report, okay? What do you read? New orders, production, employment. What do you read? I think most economists will tell you that you should read this, okay? Also, if you've read my How to Trade the Employment Situation Report, how to prepare for the employment situation report and how to trade it, if you've read that, which I published at FX Street about 5 years ago, you'll notice that in my non-farm payrolls modeling, I use the employment subcomponent component of ISM. But I don't use ISM manufacturing, I use services, ISM services for that. But you could still, I think if you were on Bloomberg or CNBC, they're talking about one of two things. New orders coming in, and they'll say, oh, that's the economy, right? Or this. How many people would agree with that? That's probably 95% of what you read about when you read newspapers or you watch financial TV. How many people would agree with that? They'll say, oh, well, if you look at the new orders, and especially around non-farm payrolls, they'll say, oh, well, if you look in the change of the employment data, this will tell you blah, 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 blah. But here's the problem. As new orders go up and up and up, they're going to need to have employment. So they hire and hire more people. Or you look at average hourly work and stuff. So it's hours as well as people, right? Number of hours worked. You can look at number of people. You could look at capacity utilization numbers. That kind of stuff. But all tells me the same thing. If the factory is humming 24 hours a day, they're going to they're going to hire more and more people until the factory is humming at 24 hours a day. And at some point they might have to build another factory, but they don't want to do that because that's risky on the long run. It's expensive. So they're trying to get closer and closer and closer to 24 hours a day. But of course, as they do that, they need to hire more people, buy new equipment. And of course, they're only going to do that if they get new orders. So to me, it's the same. They're different sides of the same coin. So that doesn't tell you, because as new orders come in, like how far in advance is this telling you? 1 to 3 months? Right? And then as orders stop coming in, then they're going to start cutting back on employment, but you already knew that. So this is, let's say, 3 to 6 months. What is more intelligent? How could we be smarter than a Wall Street Journal reporter? Leo says, what if they go in opposite direction? That's not going to happen. You're not getting more orders and you're like, oh, damn, look at all these new orders. Start firing people. Okay, that's not quite likely to happen. Maybe if you're in a trough, but it would be that's a sort of a question between long and short run. So like on the long run, you're going to have to, if you have lots of new orders and you're at full capacity and utilization, then you're going to have to add another factory. But when you're talking about adding a new factory, that's long run analysis. And in this, what I'm talking about is short run analysis. And then in the period of 1 or 2 months, if you're getting new orders, you're not laying people off. It doesn't make any sense, right? Now, if you do see it, it's because you're looking at short run versus long run. And then you're not analyzing the same thing. It's sort of like scalping on a 4-hour chart. It's not quite right. Okay. So how do we do this, guys? I'm about to blow your mind and make you smarter than 95% of people that trade these markets. In fact, probably 95% of people. What was the most important thing when it came to your parking lot? Fundamentals, yes, but how do you measure that? Don't say something esoteric like the economic business cycle or something. You're a parking lot operator. So what is it what product or service do you offer? Thank you. Kareem's got it. Occupancy. I just explained it's not price because by the time it's happened, it's already too late. Alex says, yeah, price, which is occupancy. If you were manufacturing something, what would it be? What's the word for that? Your factory has produced what? It's not occupancy. It's not space. Wait for it. Come on. If you were a factory, not orders. Orders are a future thing. You haven't done anything. They've only sent you the order. Product. Inventory. Thank you, Jean-Guy. Inventory. If you're a factory and you're making stuff, it's when you can't get rid of it that it becomes a problem. Okay? And this gives you probably 3 to 6 months before new orders become a problem, and right? And then 6 to 9 months before the employment crashes. So, when you read this out of Japan, when you read this out of Germany, when you read this out of the United States, when you read this out of China, this is sort of like factory stuff. Capacity utilization, ISM, all this kind of stuff. It's all part of that economic analysis. Watch inventories. So as inventories build up, that's bad. First of all, you have to store it somewhere, and that costs money. Also, factories live on cash flow, which means they borrow on the short run from a bank, make the inventory, and then sell these products to a wholesaler or retailer or a different manufacturer if it's an intermediate good. Okay? So now they have to store it, and they have to pay interest on their loans. So typically this is a bad thing. Now right now loans are like free if you're European, and that's one of the problems. So now you can just sit on your inventory, and instead of doing something to fix the problem, the frog is going to sit in the warm water forever. And by frog I didn't mean French. Don't go there. But anyways, you can watch inventory levels, and as inventory levels rise, it's the same as watching in real estate. Prices are not moving at all. In fact, here's the thing that'll blow you away. As prices are rising in the real estate market, you will, and this goes back to whoever asked, what if they go in the opposite direction? This will happen. This definitely does happen when it comes to the real estate. Prices will go up and occupancy rate will fall. Okay? And now you sell every apartment building you own to some loser with money. Because they look around, they're like, man, rents are high. And look at the value of this apartment building. Wow, it went from 10 million to 12 million in just a year. I better buy it quick. Yeah, dude, you better buy it for me for 13 million. I'll hand it over. And 3 years later, you buy the building back from the same person for 8 million. Do them a favor because you're kind. And you buy all that cash flow back. And guess what? Within a year or two, the economy will come back and occupancy rates will go back up. Hey, it's not your fault you're the smartest person in the room. Not your fault. The world needs you. Okay? Okay, so there's the difference between, let's say, factory or let's say industrial analysis. Okay? Industrial analysis inside of GDP. And in real estate. They face different cycles, by the way. A-Rod says, can't they lie? Well, ISM doesn't lie. It's not. It wouldn't benefit them in the least. Okay, they're an industry. They're a trade group. They're not a company. So there's no reason to lie. There's no reason. There's just that's not what they do. Yeah. But anyways. Okay. Our A-Rod? That's funny. A-Rod. True dat. Good point. So anyways, I didn't realize I was going to do fundamental analysis of industrial economic activity, the real estate market, or a parking lot. But I hope you appreciated that today. If you did, would you please leave a comment? Would you please leave a like? Will you do the thumbs up dance for me, please? Hit it and hit it hard! Would you? I don't know. I hope someone said, oh, that was actually pretty cool, man. That was actually interesting. It has nothing to do with Forex. Well, it does, because let me carry the ball over the goal line for you. When is the next recession in the United States? Do you think that's worth money if you can accurately predict that? Is it a question that's on the minds of people with money? Would people with money pay you to have that kind of knowledge? Especially if it comes across as information that you didn't just read in the Wall Street Journal yesterday or scammed off of CNBC. Then you should bust out analysis like this and say, let's use factory inventories around the world as a leading indicator to a recession. Because how do you get into a recession? What is causing the dollar weakness? It's risk on today. You should know that. It's just risk on. All the yen pairs are up, all the dollar pairs are up. That's all. So the two things that you'll see in a recession, and then think about what is the dual mandate of the Federal Reserve, and put that together. One is economic activity has a massive slowdown. And two, people lose their jobs. So what happens first? Before the economic activity slowdown? Because it's not recorded until it's measured. So what happens before? Inventory buildup. Factories made a bunch of stuff because they anticipated in the past that now and in the near future people would be buying their stuff. And they were wrong. And they're like, I guess it's a bad month. Then there's 2 months with inventory and the inventory gets higher. And they're like, yeah, well, interest rates are high. The carrying costs are low. Things will get better. 3 months go by. Oh my God. We have 3 months of inventory in the warehouse. And somebody says, hey, boss, maybe we should slow the factory down a little bit. We don't have a place to put more widgets and gadgets. And they're like, okay, well, let's take off the graveyard shift. Okay? So suddenly they lay a bunch of people off and they buy less raw material. If you're a steel manufacturer, you stop buying iron ore and coal. And you lay off one shift. And now you're starting to see this, not just your factory, but everyone around you. But see, the smart person knew 3 months ahead, they're like, ooh, this is going to be a problem. And not only is it just happening, it's happening in a predictable year. Okay? I told you by the end of 2019, beginning of 2020, you will see it. You will see it. Watch. Okay? Is it a devastating super cycle like we had last time? No. But one of my concerns as an economist is that 10 and 11 years after the financial crisis, Europe has done nothing to fix their problems in their financial sector. Right? Hey, man, check out the banking industry in Italy. Good luck. Okay? What about Japan? Oh my God, they've done nothing. Oh, well, you got our 3 arrows and blah, 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 blah. Hey, man, Japan had an amazing opportunity to fix a 25 to 30-year problem, and they, with devastation, screwed the whole thing up. Unbelievable. They got so close to being a hero that people would study them in universities for over 100 years, and they screwed the whole thing up. And I think they're worse off now than they were 10 years ago. And they were in a bad place 10 years ago. So like so you have Canada, which was never in a financial crisis to begin with because of their sound banking system and their conservative culture. So Canada never had a problem. Their only problem was any investment outside of Canada. America, as soon as they realized they screwed everything up, they drink the bitter medicine and they fix as many things as they possibly can. The major screw up is the government, not the industry. But that's typically a sign of capitalism working. The only thing not working in capitalism is overbearing government, right? But okay, so that's that. Australia is conservative and disciplined, but just overexposed to China risk. And China is all about global macro. And like Latin America doesn't even exist on an economic map, right? That's unfortunate. Africa doesn't exist on an economic map. Have you ever seen the maps of like economic activity? You're like, oh, I think that's South Africa. I can't quite see, right? I guess that is, right? And then what? Europe is screwed up. Oh my God, right? So come on, Europe, get your act together. So what do we need? Another 10 years for Europe to get on board? So my concern is like, not enough has been done. Right? No, Argentina doesn't suck. Their economy sucks. Argentina's wonderful. Chile is wonderful, right? Brazil, I love Brazil. Yeah, everybody loves Brazil. The economy sucks. But Brazil will do better than the others. They have a lot of natural resources and stuff. But like, we got to. This is a very fixable situation, right? And yet, people are not fixing it enough. United States has not fixed it enough. But see, the United States, 70% of its economy is the United States. So it could play its own game forever. But, can Belgium live on the Belgian economy? I don't know. So anyways, that's my bigger concern, is that we need to fix this. And of course, when you look at a company, very often what happens is somehow, some way, B people get in charge, and all the A people that started the company and made it awesome, they all retired rich. And the B people are resentful, and they think they're going to do it better, and of course they can't. And they're threatened by smart people smarter than them, so they hire a bunch of C people. And like, what do you do to fix that? Right? What do you do to fix a situation like that? Well, you need an A person to come in there and fire everyone. But you can't do that in Europe. And so what do you do if that's a European economy? What if that's a country, right? Are mediocre people going to let better abled people to fix things? And it's just not likely. And if anything, you start hiring C people, right? And so what happens is, I'm worried that Europe goes completely straight up socialist. And I can guarantee you that's failure. It will fail. So what we need is more capitalism, maybe a better form of capitalism. I'd rather someone say, okay, we don't need to go socialist here. Free money for people that don't have any money. That doesn't work, my friend. But what if we all agreed that the current version of capitalism has failed and we'll create a new one? Okay, so in the 1930s, we kind of said that in the United States. Okay, And part of that had to do with the economy crashing, but part of that had to do with veterans returning back from World War I, spending horrible few years in the Somme. So they come back blind from mustard gas and stuff, and thousands and thousands and thousands of men are coming home from Europe blind and injured and shell-shocked. And so, this was a problem on the U.S. economy just before the big, and there was a mini financial crisis before the 1930s. So this was on the minds of Americans. And we said, well, we got to do something about the veterans. We need to take care of them. And therefore, we're going to need some taxes. And they started creating taxes and stuff. And partly was the catalyst for income tax and all that kind of stuff. And so people were saying we need a better form of capitalism, something that has less boom and busts and all that kind of stuff. And even during the 30s, the Fed made some major mistakes, but they were learning central banking, right? And so we made some changes. And all I'm saying is capitalism can adapt. And that's one of its benefits, is it can adapt. It's adaptable. And so I think we could agree that some changes could be made. So in the 60s and 70s, you had Milton Friedman. How many people have read Milton Friedman? No, I didn't say Keynes should be. No. You need to know this stuff. So just because you disagree with it doesn't mean it should be removed from schools. No. Right? No one's read Milton Friedman? Oy vey. Come on, guys. So anyways, Friedman said, look, capitalism is the way to go. It's a way to manage an economy and a society. And there are some limitations to it. But if you need it to grow and survive and provide money so that you can give back to the parts of society that needs it, you need to let business manage itself. And his argument was businesses are self-interested. So they're going to regulate themselves. They might be corrupt for a while, but that's not the best way to go. And eventually they'll be exposed that they're corrupt and they'll die. The better thing for a business to do is provide value and to their customers and then drive down prices. And it's an inevitable part of capitalism where prices will come down because of competition. So for capitalism to work, you need lots and lots of competition, right? And then competition will come in, drive down prices through efficiency. So now businesses are making investment into better manufacturing stuff. So he would have argued now, eventually a business would say, look, pollution is inefficiency and inefficiency is expense. And to compete in the world, you have to drive down costs. So even a company like Walmart will invest into solar panels for all their stores and all their manufacturing facilities or distribution facilities to lower the cost of these facilities of managing them. And by the way, Walmart did do that, and they saved $9 billion a year. $9 billion a year they save in energy costs now than 10 years ago. So that's what Milton Friedman would say, is that they would self-regulate. But we also know that that's not quite true. That it's not quite true they do that. Their government should be part and stuff. And so now the new logic, so if you read Michael Porter, Harvard guy. If you read Porter's stuff, he says, well, you got to take it one step further, and a company should realize that its customers are also its employees and other people in the ecosystem, and that if companies made, it's not quite right, but the world a better place. A little more targeted than that, though. They make the industry and their customer and the value chain of their constituency, all stakeholders, a better place. Through things like investing into technology for cleaner air, or having more transparency in their financial reporting to potential investors, to enriching the communities around not just where they sell their products, but maybe where they make their products. And like, for example, provide free education to children of employees. In particular, let's say if a factory was in a poor country and they did that to be able to access lower costs, which is a normal part of capitalism, not only do they get workers at a lower cost, but they would be better off if they also provided food and education and healthcare. Like, for example, and I had this conversation the other day with my wife, I said, look, if I was the CEO of Walmart, I would take over the business knowing that I'm the second or first, the largest or second largest retailer in the world. It's just me and Amazon. Okay? But I would also recognize that people hate Walmart because they think it's a disgusting place and it's all Chinese products, and I treat all my employees horribly. They get paid hardly anything. I screw them on their vacation and their benefits, right? Also, I can save a nickel. So I would walk in, and within 10 years, it might take me longer. Let's say within 20 years of me being CEO of Walmart, Walmart would not only be a massive global retailer, but it would be one that business schools would write about because how well I treat my employees and how much I reinvest into my employees, providing them great wages, providing them with great benefits, things like, paid time off and leave to have children, and then even to have scholarships for all my employees' children to go to university and stuff like that. And we would be a leader of green technology and stuff. Do you know why I would do that? For altruism? Because it would make money. That's sort of the new model of capitalism. It would make money. People would be proud to shop there. People would be proud to work there. Can you imagine the service you would get walking into a Walmart and they are proud to work there? It's a great job and there's employee satisfaction, not just customer. They would come up to you, let me help you. Let me put the t-shirts down. I'll fold them in a little bit. How can I help you, customer? Let me take you, right? It would make more money. So capitalism is adaptable, and we're moving closer to that now. Companies are good because they do good. And because they do good, they make more money. They make more money because they do good, not bad, right? It's a new form of capitalism that's coming. The old school of the race to the bottom is going away. Now, couldn't we also do that with countries? Instead of saying, hey, elect me because I'll give you a bunch of free money from the government, and to get all this money, I'll just jack up taxes on all the rich people and all the businesses. But look, if you thought about it for 4 seconds, you'd realize all those businesses are going to go away, and all the people with money are going to go away, and everyone will be equally poor. And then look back after the last 300-400 years of social experiments and find out what happened? So don't throw capitalism away because it created things like income inequality. Address it. And some ways don't fight it. If an entrepreneur builds a business, now he makes $40 million a year, don't hate him. Now, if you're CEO of some dog food BS company is paying himself $500 million a year, the shareholders should fire that dude and see if they can find someone that will do it not for $500 million a year, but $50 million a year, right? So that should be done with your money. You buy the stock or you sell the stock. I mean, that's how capitalism should work. People should reject that and say, there's no way this CEO, yeah, he manages 50,000 people, but that's not worth $500 million a year, right? And, fix that. But capitalism is fixable. Okay? So anyways, I hope Europe doesn't fall into a big, giant social state. It didn't work well in the early part of last century. So anyways, let's see where things go. Remember, capitalism means trade, and trade means peace and prosperity. You want peace on the earth? Everyone should trade together, and everyone should make money together. And as long as they're better off and they feel good about their children's future, we will have peace on earth forever. Cool. Do you want to do some Forex? It's all right. It's all right. Up, 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 down, down, buy, up, 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 down, down, buy, up, 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 down, down. What do you think? We also want to catch the bottom of the channel. So we'll see if they hit. Says you can make money with war too. That's also a fallacy. That's a gross misunderstanding of economics. Do you know what externalities are called, or what externalities are? It's costs society have to pay that a company doesn't have to pay for. So, for example, let's say a factory doesn't pay to have pollution controls put on their smokestacks. How much does that cost the company? Doesn't cost them anything. They're just polluting. But it costs society something. So there's a form of economics that say, well, you should count that because it causes health problems. It causes quality of life problems. It causes all kinds of problems. But to discount it is like, right? So for example, the government might create money from nothing, because the government can do that, and create demand for things like jeeps and tanks and airplanes. And that creates economic activity, in particular for defense contractors and stuff. Sure, they make money. But society loses a lot more. First of all, it creates inflation. It creates debt, right? And then, of course, you have human beings dying or coming back maimed and now have to be reintegrated into society, right? And if the war is in your country, you also have capital loss. That means buildings and factories and machinery destroyed, non-repairable, and depreciated to zero. All of which is economic cost. But then you say, oh, well, but Boeing made a lot of money. Yeah, but that's too short-sighted of a... But that is what's taught. So whoever said that, I forgot now. Whoever said that, that's what's taught. But of course, that's nonsense. Okay. Where do you get... What's going on? 21-year average for your... Interesting. So, anyways, so are you a buyer or seller of gold? Should be pretty straightforward. This actually says is the better buy. So what the charts are saying is one more dip and then counter trend. So between now and Tuesday, gold hits I don't think it'll hit 1,400, but let's just say 1,400-ish. By the end of the week, back to 1,450, and by the end of the month here, up. For that, we're going to need a weak dollar, which is good economic news. Again, a trade deal would do it, and all kinds of things could do it. A Fed indicating that they're done cutting. But I listened to some bond traders on Friday, some pretty well-known shops that do bonds, right? And 2 out of the 3 traders were adamant that the 10-year T-note is going to 0. And if they're right, the dollar's going to be way down here and probably significantly lower. So that might be this year, that might be next year, or they may be wrong. You need to make your own decision. Okay? But their argument was the rest of the world is at 0 interest rates. Why not the United States? That it's inevitable. So a year and a half ago, the 10-year T-note was paying 3.25%. A few months later, it was paying 1.25%. Today, it's paying 1.75%. And they're saying, so how about this? We'll have to thread the needle here. Stock market decline, U.S. recession, Fed cuts interest rates, 2-year goes to 0, 5 years goes to 0, and 10-year certainly below 1%. That's what they're saying. I don't know what you're saying, but that's what they're saying. Taxes, does Dixie affect stock market? They're correlated. So TAC, let's say you don't live in the United States, but you wanted to buy U.S. stocks. You'd have to buy dollar first. Now with your dollar, then you could buy U.S. stock. So you're saying, well, does the stock market impact the dollar? Well, if it makes you want to buy it, then yes. Or what if the value of the dollar is low compared to your currency and you get a good deal on buying dollars and you want to be exposed to the U.S. stock market? Well, then the cheap dollar. Now, the cheap dollar usually comes from a bullish stock market. So if that means the stock market's rallying, the dollar's weak, and you're like, oh man, I can buy this rallying stock market with some cheap dollars. So yeah. But right now, the rest of the world is so pathetic, moving toward their pathetic form of capitalism, that their currencies are going to be worthless. And as long as everyone else's currency is worthless, the U.S. economy will be worth more. Okay? Why? The U.S. economy is the largest and most mature economy in the world. It's always going to be worth more. That doesn't mean the dollar can't be weak. You want it. You want the U.S. dollar to be weak. I love a weak dollar. So if the U.S. economy goes into recession, the U.S. dollar is going to get ridiculously strong. Ridiculous. And why does that pull gold down? Well, first of all, gold can buy U.S. dollars. But why does someone buy gold? What are they hedging against? Okay. Gold is an inflation is a hedge against inflation. The Fed's cutting interest rates. That means there's no need to have there's no inflation. No, Craig, I haven't had time to sell you stuff. I'm sorry. I'm going to try to do it today. Yeah. Yes. So gold is a hedge against inflation, and the Fed would be cutting interest rates if there's no inflation. So gold would be weak, dollar would be strong. Someone posted a question, if the Fed decided to do QE4, what would the impact be? Well, what would QE4 be designed to do? You'd only ask that question if you didn't know what QE4 did. So I would invite you to take the fundamentals course at FX Bootcamp, which then only tells me or reminds me that I'm supposed to create a Black Friday coupon for you guys and give you a massive discount. I haven't done it. I haven't had time. I'm working sometimes 5 and 6 hours a day on homework over the holidays. So anyways, I need to do this because I can answer your question. It's like, to me, it's like someone asking me, hey, Wayne, can you recite the ABCs? So I go through and I do the ABCs all the way through A through Z. And they're like, okay, but can you count to 25? And I'm like, I can count to 25. Can you count from 25 backwards to 1? Yeah, I can do that too. Yeah, I can do it, right? So, what would QE4 do? That'd be like 25, 24, 23, 22, 21, 20, 19. Right? So I would rather you take the course so you absolutely 1,000% over. Know what this would do, and you should be able to draw a graph to explain it. Okay? Hope I did not say Milton Friedman was the most important economist post-war era. I never said that. So maybe someone put that in the comment. But I've read every economic theorist for the last several hundred years. So I know what Milton Friedman said. I've actually analyzed things like his tax proposals and stuff like that. So I got the knowledge and the skills. I'm putting them together, but I never, because I don't think that. I never said Milton Friedman was the most important economist of the post-war era, although he certainly could be considered one. Okay. And I go into these things really unbiased. So I know lots of people love him, lots of people hate him. I don't love or hate. Okay? That's why someone said, oh, well, you shouldn't have Keynes, right, taught in schools. I'm like, no, you totally should. You should understand, right? And then von Hayek. Like, how many times do they teach you Keynes, but then you don't read von Hayek? I'm like, well, how could you possibly read Keynes and not read von Hayek and understand the battles and debates that they had as economists to really figure out some of the flaws in the system and how to address it? And then, now that history's gone by, what worked and didn't work, what was good from both and what was bad from both, and what is going to happen in the near future. That's the way I think. Okay? But Hope, you can't say he wasn't an important post-war economist, but I didn't say he was the most important. Okay? Cool. Well, I guess that's it. I guess we'll pick up tomorrow. No. See, I agree. I disagree with this idea that Keynes is only socialist and stuff. The bulk of what Keynes was saying is that when you do demand side analysis of the economy, in times when the economy is going through its adjustment phase, which is actually a normal, healthy part, governments try to stop this, right? Governments try to stop the cleansing, right? But we know if you prevent forest fires, what happens if you prevent forest fires too long? You create one mother effing forest fire, okay? What happens? What's another example? Anyways, so when you prevent the boom and bust of an economy, you're stopping a natural cycle, which will only lead to something 10 times worse down the line, but then it's worse. Instead of having recessions every 8 years, every 30 years you have a depression, right? So anyways, so what Keynes was saying is, look, when the economy is going through a down cycle, a deleveraging cycle, I was thinking of deer and hunting, right? You must cull the herd. So if you shoot all the wolves, what happens? Then all of a sudden you got deer and elk and moose everywhere, and it gets so much that they're starting to be forced into land they shouldn't be in, and disease starts kicking in, and from overpopulation, and all of a sudden they all die. Okay? So you need sharks, you need snakes, you need hawks, you need wolves. And in the long run, what it does is it keeps the deer herd at healthy numbers, and they get rid of the sick and the weak, right? And the herd becomes stronger. So economics is very similar too. In particular, capitalism, it has its booms and bust cycles. The government shouldn't say, oh, we need to get in and stop all this. No, that's a politician trying to get elected. But right? So anyways, Keynes said, look, when the economy comes down, the government should step in and create demand by stimulating the economy, not giving the economy money, but actually buying stuff from factories, like buying more planes from Boeing, for example. But also back in the 30s, Roosevelt created something like the CCC, the Citizen Conservation Corps or something, and actually pay people to build hiking paths through all the mountains and stuff like that, and build beautiful post offices, and he put millions of people to work, and they made amazing things. I still go to state national parks and see the work that the CCC did, and walk on the paths that they created, and the cabins that they built, and the dams that were built in the 30s were amazing, all leading to infrastructure that is still used today over 100 years later, or nearly 100 years later. So he said the government should step in. But when the economy recovers and business is strong, tax them and save the money. Save the money. Then, when the inevitable happens and we go from a growth cycle to a downturn, the government could come in with the money it saved and support the demand side of the equation, supply and demand. Come in and support the demand side. The problem is the government doesn't save money. So it bails everyone out now. When they're supposed to go out of business, the same stupid companies are in business again. Well, they're the problem in the first place. They should go out of business. But anyways, so now they're all saved, right? Great. Then what? Then the economy starts booming and the government spends, and they don't save any money. They actually come out deficit. So they were deficit in a down economy and deficit in an up economy, and they're also part of the problem. They don't let the bad companies die, and then they don't save any money when money is raining out of the sky from taxation. They spend it on other crap we don't need. And those two things are the problem. according to Keynes. So like Keynes isn't like a socialist pig dog. Now, spending government money to prop up an economy can be considered that, but that's not quite what he was saying, nor is Keynesian economics followed properly by the people in charge. So Keynes would say, oy vey, I never said that. He'd be mad. And of course, by the way, we're judging Keynes by what he said in 1940, right? The models have changed. So we went from Keynes to like, let's say Friedman, now Friedman to like Porter, and Porter will change in the future because we'll find out that it all doesn't, the world isn't quite exactly that way. And we'll keep learning, we'll keep better. But my question is like, if Europe goes backwards into socialism, why? It doesn't make sense. We already studied all that. It's like Trump, people who criticize Trump for the trade war, and it's true. Trade wars are bad for economics, and building up walls is bad. We've known that since Machiavelli. But that's not quite what he's doing. He's renegotiating trade deals in an open trade globe. And China was given a great deal to entice them towards capitalism and away from socialism. They took the bait. They became capitalist. China is a wonderful country, wonderful opportunities, very, very capitalist, fantastic in many ways. Horrible in others, but fantastic in many ways. Great. They don't need the same deal they needed 40 years ago when Nixon went there. So that makes sense. So we'll spend 5 or 10 years renegotiating. That's cool, man. It's only 5 to 10 years. In the scope of your lifetime and your kid's lifetime, that's nothing. And we'll have a more balanced trade deal, and we'll have peace on earth from improved trade and lower prices and more employment and healthier people and longer life cycles and healthier people. And okay. So anyways, thank you, Cash. All right, so I guess I got to go. We went really philosophical today, economically philosophical, so I hope you appreciate that. So I don't know, maybe we're still in holiday mode. I kind of feel like we got into this was more of a book club than analysis today. So I apologize if you're upset by that, but at least maybe food for thought, or maybe great discussion. Maybe it's kind of like a cigar and a cocktail, and we just hashed out everything. Where we went from Machiavelli to Milton Friedman to Keynes. I guess we have to do it in order. Machiavelli, Keynes and von Hayek. Then we went